The evidence is building that the markets are turning, and it's just a question now of working out the degree of turn that could well come upon us. So we've been talking recently about the fundamental analysis around this, and now we have a chance to take a look at the technicals with Ron William, technical analyst from RW Advisory, who joins us on the line now from Hong Kong. Ron, welcome. Happy New Year to you, first of all. And I have to say that we have spoken about this reversal setup pattern now for some time, but it is beginning to look like it could well come true. The title of this is The Evidence, and I want to give you the opportunity to explain to us your thinking along this line and where we do go from here.
The key approach is certainly a blend of qualitative and quantitative measures. So looking at the market from a behavioral standpoint with the drivers of market timing or cycles. And so that's what we're doing right here and now and always. But what's most important is the fact that trends, yes, they are our friend, but they also have an asymmetric nature. And so at some point in time, if the market continues for too long, then the risk to the downside is greater and harder. And so that's the inflection point that we see ourselves in opening into the new year of 2022. Some people talk about the January barometer. January is already looking negative as we see some of the shakeouts happening specifically, across the risk markets, US in particular, and tech in terms of sectors. So it seems to be a risk zone where we are right now. And there's a line on the sand in our opening chart of the S&P 500, that 50-day tactical trend average.
Yeah, well, let's pick up on that and bring up that chart as we got here on the screen at the moment and talk a little bit more about the significance of this move in the grand scheme of things and your setup for the markets to move further on down.
Yes, so as a preface, the long-term strategic averages are 200-day annual measure, tactical 50, and then for more active traders, 20 monthly average. The 50-day moving average is not only divisive in terms of its tactical time frame, but also in terms of the line in the sand that it has drawn for most buy on the dip, buy on the dip, buy on the dip passive traders and investors. So these same conditioned professionals are now finding themselves in a little bit of a troubled situation, because now that friendly trend is reversing yet again. Important to add the detail on the chart there that there have been previously 9 consecutive buy on the dip reactions. One in September and October when we last spoke, where we had the traditional autumn fall crash seasonality pattern. But now it looks like it could be the real thing. Also because there was a confluence of price and time signals, price in terms of the reversal below the average and the swing lows, but also we had a DeMark exhaustion signal, multiple along the recent peak levels, and the risk zone on that is 48.05. So things can be reassessed to the upside only if we break above that 48.05 level on the S&P 500 and the equivalent of the markets. And then the 200 moving average is not far away at 44.20. That would be the next target to go. But just keep in mind that line in the sand, which has held so many buy on the dip passive traders, investors for over a year. We had less than a 5% correction for that duration of the time, with exception to the last autumn. And so if and when that does unravel, that would create a sharp elastic band effect to the downside. And that's the insert chart there on the bottom right, just showing on a long-term basis going to, I believe, 2018, that this is part of what I've called a Minsky risk pattern, which is a volatility signature with a pattern of higher peaks and lower troughs. And essentially, that creates a bull trap on the high side, and if and when confirmed, a crash potential ahead.
It's interesting, isn't it, talking about the moving averages? I notice actually as we speak, we have just seen the NASDAQ and the Dow Jones Industrial Average disappear below that significant level of the 200-day SMA. And now you talk there about the S&P 500 getting close to that level. Let me just get you, if you can, just to quickly recap this boom bust cycle. As I say, we have spoken about this before, but just talk to us about the nature of it and illustrate it with another chart.
Yes, well, this is a good educational framework for how cycles work in theory, but also most importantly in practice. It's based on the work of my mentor, Robin Griffiths, that originally derived this based on regression analysis. And essentially, it is the boom bust market cycle driven by greed and fear, greed on the upside, which is the kind of mountain climb up in terms of shape, and fear on the downside in terms of the cliff drop. And so that essentially is how markets work. And throughout that time, there are stages of a business cycle, and we are currently in what is deemed a very late cycle stage between W, X, and Y. The trouble with applying this model in the recent cycle has been timing, of course, because we've been on borrowed time for so long, given that we had central bank liquidity coming to the rescue of the post-COVID situation and the follow-up FOMO behavior of fear of missing out, which is at record highs. So the liquidity and the sentiment combination did extend things. And instead of having one particular recovery on some markets, we've had a K-shaped recovery where there have been some winners and losers. So right now we're at the Y side, where markets have moved to new highs, others have failed to do so. Either way, the one-size-fits-all prediction is down when volatility rises after an overextended boom. Then the pressure switches from up to down, and that's what we're seeing now as part of this Minsky risk.
Okay, so moving on to the next chart and taking a look at this in the context. I know this is illustrating the Nasdaq, but you've got this idea that we could well see this drop continue well into Q1, and then sort of a recovery come through, and then the potential for further declines.
Yes, well, that's what the previous chart also showed, actually, that the traditional correction or crash pattern is 3 stages. You get the fall, rally, and then rest of fall. That is traditionally how markets transition from bull to bear cycles. And that is actually what one of the newer cycle models that we used, developed by the Foundation of the Study of Cycles, a nonprofit organization that specializes in this field. And based on their signals, you can see it's suggested ahead of time that the Nasdaq was going to peak along with other risk markets, but Nasdaq in particular, into Q1 of this year. And that would be followed with a correction and a potential rally, so that 3-stage move, the midpoint. And then in the preceding charts, there's an additional model which is integral to the RW approach, which looks at economic models, and basically there's a confluence of all of these timing measures together.
Talks about the economic backdrop as well here, because clearly that is going to be important.
Yes, well, I mean, certainly the blended approach, it needs to be behavioral driven, but that includes macroeconomics and, of course, the technicals. And on the economic side, what has been at the heart of RWA analysis originally, complemented with the work of mentor Robin Griffiths, is this Schumpeter adapted economic cycle framework. And that is just basically a mix of key cycles, long, medium term, and short term. On the long side, we have what is called the contractive wave, which ranges from an average of 54 years. And that tends to be highly influential to interest rates. And so there's the beginning of a normalization and the bottoming in rates. And so we're starting to see rates go higher and central banks starting to actually change policies, just recently with the Fed, as a sign of change ahead. And of course, that hitting the markets hard now and in the future. The jugular, which is the big business cycle, 9 to 10 years on average. And the kitchen cycle, which is more linked to the presidential cycle, that's an average of 4 years. And then lastly, what a lot of people will know is a seasonal cycle, like the January barometer or Sell in May and Go Away or the Santa Claus Rally. These are all seasonal plays. If you actually test out the main cycles on the left side of this slide, the results are on the top right, chart A. The 9 to 10 year cycle, jugular cycle, is the dominant one from a statistical basis if you test it over 100 years of data or more. And a combination of that cycle and the 4-year cycle, that combination shows that we have a likely mean reversion risk in the second half of this year. So what we're doing here is to show you a little bit of what's underneath the car bonnet, as it were, just so you can see the mechanics of how cycles work, particularly when they confluence together. That's when they become more high probability, and then added with a technical framework, we get more of an edge on the timing and the likely price move.
Let's take a look, if we can, at where we are in terms of the cycle rotation. This idea that you illustrated there, that we've got this big drop in some of the growth stocks. Value stocks tend to hold up a little bit. But talk to us about some of the cycle rotations using the qualitative modelling that you also use when bringing together all this as an idea.
Yes, well, it's really important to all frameworks to have a blend of qualitative and quantitative. Previously, we were looking at more the quantitative in terms of the stats and crunching the numbers, which do matter, and they give some kind of a benchmark of what to expect. But of course, the quality or the characteristic of the market cycle differs from one to the other. And so this is really important. And this is more rooted in the heart of technical analysis by looking at the behavior of markets. What are the key drivers from an economic point of view, from a macro risk, and then just in terms of rotations that we see. So the framework on the left is looking at 3 key factors: growth, valuation, and technicals are the main components. Growth is basically falling. We're in late stage on all of the above, but on the growth side, it's falling post peak. If you look at US and China markets as being the key engines, so that's tick box number 1. Number 2, valuations. We measure greed, assets versus fear, and that is now starting to rank downwards from a very kind of overbought situation over the last year or so. And on the technical side, it's a mixture of things, but probably the strongest signal is the market internals being very weak. If you look at breadth, I think pretty much 50% of sectors and stocks around the world are in bear trends, i.e. they are below their 50 or 200-day moving average. And so that just shows that any rise or record levels that we've been seeing have been built on quicksand. And so that foundation is not strong, and we can easily get some sharp volatility happening. I did want to include a chart on the tech sector growth example, which has had a pretty hard shakeout, having already enjoyed some of the best runs to date. And so value will likely outperform, and the cash preservation and just general long quality bonds and defensive sectors will be the better focus. And looking at global cross asset, gold would likely be a good safe haven play going forward.
Yeah, that's the old idea, isn't it? That safe haven assets include gold. We've seen a lot of debate, I know, Ron, about Bitcoin. I'm not going to go there, but of course, obviously, there are other younger members of the market where some are suggesting we could well see some safe haven. Doesn't seem to be playing out in cryptos at the moment. Just wanted to end, if I can, by bringing up a chart of the S&P 500. You mentioned this earlier on, and I was talking there about the fact we're very close to breaking that 200-day moving average, which you illustrated quite well. This is a chart that goes back to 1995. It's a it's a monthly chart, or a chart that is actually broken down into weeks, but it takes broad monthly swings within the move that we've got. And I've also illustrated here the COVID lows. Just wondered if you can just to look at this chart in the context of what you're talking about here. Now you're talking about this two-wave drop that we've got. And I've illustrated the COVID lows here. Just talk to us a little bit about the declines you're expecting for the S&P 500, bearing in mind this idea that we've got this pullback in Q1, slight recovery, and then a further pullback on the way down. Do you see the COVID lows being broken in any of that price action?
It's a low probability, but growing. And certainly we would need to see how the market unfolds in this existing correction. As you correctly highlighted, first stage in Q1 thereafter, and then probably the bigger part in the second half of the year going into 2023. So there's a number of ways of looking at this. First point is going back to the peak levels of the crash of 2020, I think is going to be decisive, because that will actually give us our first target, but then also it will trigger the Minsky risk technical pattern that I've been citing for some time now. That is the expanded triangle pattern or volatility crash signature that would activate a move down to the COVID lows. So that's how the behavior and the pattern would likely play out. And that would be driven, just to add, by all of the aggravated long positions on the upside that basically get squeezed and turn around. That gives the market extreme momentum to the downside if and when we see a revisit of the peak levels before the crash. The other point to keep in mind is just the historical rhyme of market falls. In price terms, a papa bear market is 30 to 50%, not a baby bear market. A papa bear market is 30 to 50% price magnitude on the downside. But what is key is not just the price drop. It is also the time magnitude for the repair period that is required for markets to rest and recover in order to reset for that new boom, boom, boom environment, which will be something to look forward to after we pass through the shakeout that needs to happen in order for us to have that kind of creative destruction opportunity. So that average time duration is anything from 1.5 years to several years, looking back over the last 100 years. And 2020 was the fastest bear market recovery in history. So I think we have to kind of count our blessings that we did enjoy some of the best bounce back in that V-shaped recovery. But likely we have greater magnitude of bear characteristics to play out before we can then prepare for that long-term reset where boom opportunities will reappear.
Yeah. Okay, Ron, look, it's a pleasure as ever. I'm sure we'll catch up with you again later on in the year as we see things develop, if indeed they do develop along your lines, this idea that we get this pullback in Q1, then a small recovery. I look forward to that opportunity, Ron, later on in the year. But in the meantime, thanks indeed for joining us. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.